Yo guys, it's John here with Option Lab. In this one, I'm going to show you guys how I made 11,480 and 60 cents in 4 clicks. So some of you guys have been joining my Discord and messaging me and asking to make a video where I kind of break down this strategy from a simpler, more beginner perspective. And this trade I recently took on Target is the perfect example of kind of the strategy from A to Z. If you guys don't know, I trade option premium selling strategies. So mostly bull put spreads, bear call spreads, the wheel, etc. So if at any point you guys are having trouble following or you want more information, you can join my Discord right here in the description. It's free, and send me a message. I know I've been talking to a few of you guys. It's been good so far. So anyway, let's get into this. So let me make myself smaller here. All right, so this is a textbook example of what I call the wheel strategy. So this was on Target, and Target, as you can see here on the chart, recently had earnings. And you can see here it dropped from about 157.5 down to up here, down to about 120, right? So typically, if you guys have watched my other videos, the criteria I'm looking for entering into a naked put or selling to open a put, or another strategy would be a bull put spread, is high IV, right? High IV, news or earnings, that usually these go hand in hand, right? So if there's news or earnings, the IV is usually higher, option premiums are higher, and since we're selling to open options or collecting a net credit for doing so, we want situations like this. So basically what happened here, Target drops huge on earnings. In my mind, I think usually when big earnings drops happen like this, there's some sort of market correction in a short time frame. So what I'm doing is I'm selecting a shorter expiration, 1 to 2 weeks out, and I'm selling puts below where it's already dropped, expecting that it's probably going to recover within the next week or two, collecting a premium for doing so, and as you can see, it's bounced. So let's go through the actual trade I took, and I'll show you guys how this works. So this is a diagram here. You can see here the option wheel, and the first step of the mission here is selling an out-of-the-money put. So what does that mean? I'm picking a strike that I think the stock is going to stay above by that expiration. For doing so, I collect a premium, and as long as that stock stays above, I keep the premium, nothing happens. So what did I do here? Target dropped on earnings, and the first thing I did was I sold right here the 122 put for the 11/22 expiration. So this is already expired, and for doing so, I made $14.93.32. And as long as by that expiration Target stays above that price, I don't get assigned any shares, and I keep my premium. So easy money. So that expired worthless. I kept my premium. The other thing I did, because I thought Target was going to bounce and I was confident of it, was I actually bought shares right out, right? So the first step of the wheel of selling a put, if you want to continue the wheel, you have to actually be assigned shares in order to write calls, right? So instead of not only selling a put, I actually bought some shares because in my mind, I perceived this move to be somewhat of an overreaction. I was expecting a bounce. So what I did was, as you can see here, on the same date, I bought 2,000 shares of Target at 122.5. So if you go back to the chart, I picked it up here right around this level. And as you can see here today, those shares are now up over 5 points on 2,000 shares. Okay? So played the overreaction, expected to bounce back up in a short time frame, and got it. So what did I do? On those 2,000 shares, we now go to the next stage of the wheel, which is so I kind of artificially manufactured this step by buying shares, but the stock drops below the strike and I got assigned the shares. In this case, I just bought them. So now we have 100 shares. In this case, I had way more. But on those shares that I now own, I can write out of the money covered calls, right? So let's get that out of here. I don't know why that's popping up. So now I can write out of the money covered calls. And if you look here, that's exactly what I did. So right here, you could see last week I wrote I believe that was the 125. Yeah, right here. So I got assigned up here at 122, wrote the calls at 125, and it stayed below my strike price by expiration. So I got another 2K. Then right afterwards, the next week, and that's this week as we're talking, or as I'm filming this, I wrote the 131 calls. And as you can see, that actually looks like it's going to be free money based on where the stock is at. So think about this. I not only collected money for selling puts, and I didn't even get assigned the shares, I also bought shares on the dip, sold calls, collected free premium because it stayed below, and then sold another week of calls right here. So now I collected 2 rounds of premium, plus now I still own the shares. So if you go down here, the call option expired worthless. I wrote the options again. It's going to expire worthless again, most likely based on what I'm seeing. So I'm going to keep the premium again and write another round of calls. And you can just milk this over and over and over again, as long as you can scan for the right criteria. So something that I've been talking to a lot of people in my Discord about is, what is the criteria that we use for finding these positions? So I've been working with a few of you one-on-one, going over setting up scanners, and that's something that I can make another video on. But for the time being, this was a textbook overreaction on news based on a bad earnings. Play the dip, sell puts, buy shares, write calls, quick money, flip out, done. That's going to be about $11,000 in just 4 clicks. If you guys want more on the strategy, if you want to see some of these positions or you want to chat with me one-on-one, click the link in the description below, hop in my Discord, and I'll talk to you guys soon.